Okay, exercise 21-2B, an accounting for lease from the point of view of the lessee. Somewhat similar to the one that we just looked at, a little bit more detailed. So here's our story. We've got Jupiter Corp. Jupiter Corp is the lessee. They lease a rocket-themed amusement ride with a fair value of $110,000 on the following terms. So the lease term is for 10 years. It's a 10-year lease. The rental is $16,000 per year, and the rental payments occur at the end of each year. Now that's important for us again because that tells us whether or not when doing present value calculations we need to use an ordinary annuity formula or an annuity due. In this case, since the payments occur at the end of the year, the calculations are going to use an ordinary annuity formula and not an annuity due. We're told here that the present value of the recurring stream of annual rental payments of $16,000 is $98,313. So they did the present value calculation for us. In theory, the way they got that calculation is they took the recurring payment amount of $16,000 and they multiplied it times the present value of an ordinary annuity factor, where the factor comes either out of your calculator or out of an annuity table using an interest rate of 10% and n equals 10 10 payments. This 10% interest rate comes from fact number 5 that tells us Jupiter's incremental borrowing rate is 10% a year. Now Jupiter would be required to use the lessor's implicit rate if Jupiter knew the lessor's interest rate and if the lessor's implicit rate were less than Jupiter's incremental borrowing rate. But since the lessor's implicit rate is unknown, Jupiter, of course, is forced to use his incremental borrowing rate of 10% a year in doing the present value calculations. Okay, we're told here that the residual value of this leased asset after 10 years is $10,000. This residual value is guaranteed by Jupiter. That's important because that means that this residual value is going to become a component of the minimum lease payments. And specifically, the present value of that guaranteed residual value is $38.55. And that $38.55 is calculated by taking the $10,000 amount of guaranteed residual value and multiplying it times the present value of the single sum factor, where the discount rate is 10%, I is equal to 0.10, and n is equal to 10 years because it's going to be 10 years before that residual value has to be made good by the lessee. Okay, so those are pretty much the basic facts. The only other basic fact that we haven't talked about is the economic life of the asset. The economic life of this leased asset is 12 years. The lease term is 10 years. Okay, so the first part of the problem, part A, asks us to calculate the nature of this lease to Jupiter. That is, let's determine whether or not this lease is a capital lease or an operating lease. To do that, to determine whether this thing is a capital lease or an operating lease, we got to apply the 4-part test that we talked about in class. That 4-part test asks us first to ask whether or not there is a bargain purchase option in connection with the lease. The answer to that question is no. So we go to the second question. Does the lease transfer title to the lessee at the end of the lease term? The answer to that question is no. The next question we ask is whether or not the lease term is at least 75% of the economic life of the asset. In this case, the lease term is 10 years, and the economic life of the asset is 12 years. So the lease term as a fraction of the economic life of the asset is 83.33%. So the lease spans 83.33% of the economic life of the asset. So the answer to this third question is yes. So at that point we can stop. There's no reason to proceed to the fourth question, to address the fourth question, because we met criterion 3, the economic life test. Since we met criterion 3, the economic life test, we know that this lease is going to be classified as a capital lease by the lessee. Okay, so the answer to part A of the question, what is the nature of this lease to Jupiter? Well, the nature of the lease to Jupiter is it's a capital lease. Okay, so part B of the problem asks us to calculate the present value of the minimum lease payments. Now remember, there's 4 components to minimum lease payments. There is the recurring payment amount. There is any guaranteed residual value. There is any bargain purchase option. And there is any non-renewable penalty that the lessee must pay upon termination of the lease if they don't renew the lease. In this case, we only have 2 of those 4 components. We do in fact have guaranteed residual value, and we do in fact have the recurring rental payments. We were explicitly told above that the recurring present value of the recurring payment was 98,313, and we were explicitly told above that the present value of the guaranteed residual value was 38,355. So the total present value of the minimum lease payments is simply the present value of the recurring payment of 98,313, plus the present value of the guaranteed residual value of 38,55, or the total present value of the minimum lease payments is 102,168. So the next thing we're asked to do here is to record the lease on Jupiter's books at the date of the inception of the lease. Well, simple journal entry: debit leased equipment, credit lease liability. And the amount that we're going to book this leased equipment for is equal to the present value of the minimum lease payments, which, as we determined right here, is 102,168. So the journal entry is going to be debit leased equipment 102,168, credit lease liability 102,168. Both of those amounts, of course, are representing present value minimum lease payments. Okay, so we've got an asset recorded in our accounting records under property, plant, and equipment equal to 102,168, and we've got a liability here reported in our accounting records at 102,168. And that's the entry that was made at the inception of the lease. Okay, so then at the end of the first year, we have to record depreciation expense on this lease, on this leased asset. And of course, the basic journal entry: debit depreciation expense, credit accumulated depreciation, same sort of entry you've made since principles of accounting. Now, calculation of the amount of the depreciation is as follows. We're going to take the cost of the equipment, which is 102,168. That's what we booked it at right there. And we're going to subtract from that the guaranteed residual value. And the portion of the amount that is embedded in the present value of the minimum lease payments here that represents guaranteed residual value is at 3855. That 3855 present value of the guaranteed residual value, that's being subtracted from the amount at which we book the lease equipment, and that gives us the depreciable base of the asset. Then we're going to take that depreciable base of the asset and we're going to divide it by the period of time that we're depreciating the lease over, or the leased asset over rather. And the normal depreciation period is the lease term. The only circumstance in which you depreciate the leased asset over a period other than the lease term is if the lease contains a bargain purchase option or the lease transfers title to the lessee at the end of the lease term. If either of those two conditions are met, then the leased asset is depreciated over the economic life of the asset and not over the lease term. In this case, neither of those two conditions are met, so we're depreciating over the lease term and not over the economic life of the asset, which is economic life of the asset is 12 years. So you divide the depreciable base of the asset here by the depreciation period, and what you come up with for depreciation expense is 9831. So debit depreciation expense, credit accumulated depreciation for 9831. And then the very last entry we have to make is we have to book the first lease payment that takes place at the end of the year. Okay, so we've had the leased asset, we've been in the lease a full 12 months. It's the end of the year. We need to make our first lease payment. According to the facts of the problem, the amount of the lease payment is $16,000. So we're obviously going to credit cash for the $16,000, the recurring rental payment. And then we have to take that $16,000 payment and we have to array it into the part that is characterized as interest and debit interest expense for that amount, and array it into a part that is considered a payment of principal, and let that payment of principal portion reduce the lease liability account. So the way you do that is to first figure out the portion of the $16,000 payment that's attributable, that is characterized as interest. And the way you calculate that is you take the carrying amount of the lease obligation at the beginning of the interest period. That amount is simply the amount that we credited that lease liability for when we booked the lease, 102,168. And then we're going to multiply that carrying amount of the lease liability at the beginning of the year. That's the portion that was outstanding throughout the year accumulating interest. We're going to multiply that times the appropriate discount rate here which is 10%. That's the lessee's incremental borrowing rate. That 10% times carrying amount of the lease liability at the beginning of the year gives us the amount of interest expense that we need to recognize, 10,217. So out of the $16,000 payment, 10,217 is deemed to be a payment of interest, and the remaining 5783 is deemed to be the principal portion of this recurring rental payment. So then the bottom line journal entry: debit interest expense 10,217, debit lease liability 5783, and credit cash $16,000.